Hi, I'm James Dunn. Welcome to the Inside Network. Welcome to INDepth, and my guest is Varun Laijawalla, Emerging Markets Equities Portfolio Manager at 91. Welcome, Varun.
Thanks for having me, James.
It's a great pleasure to have you here. Varun, as an investor, what fascinates you most about the emerging markets environment?
I think probably a couple of things, James. One is just how entrepreneurial the emerging market entrepreneur is. Whether you look at India or China or Latin America or even the Middle East, you just come across some incredible entrepreneurs who just love business. Being able to have access to these smart people is one of the best parts of the job. I think probably the second thing that makes emerging markets so nuanced versus developed markets is the inherent cyclicality of the asset class. It is inherently a very cyclical asset class, which means that as an investor, you need to be on your toes, but you also get to see the best and the worst that markets offer. And I think having access to that and being on your toes sharpens your toolkit as an investor. That's probably what attracts me to the asset class.
Across the spectrum, Varun, you know this a lot better than most. They've been so beaten down, and then they're now at discounts to developed markets equities of about 30% and about 40% to US equities. And so much capital's gone, but are discounts of that magnitude starting to bring them back?
Unfortunately not. I wish I could say otherwise. I mean, I think if you look at the flow picture, flows haven't really made their way back to emerging markets, which is why those discounts still persist, and they're multi-decade discounts we're talking about. Having said that, I think when you think about emerging markets, it's probably worth thinking about emerging markets almost as two distinct asset classes within one umbrella. Emerging markets ex-China and then China. And if you look at the beta of those two different pieces, China last year was the worst performing market in emerging markets, down 10%. Strip China out of the equation, emerging markets ex-China was up 20% last year. Relevance of that is global indices, the MSCI ACWI was up 22% last year, with the Magnificent Seven as part of that cohort of companies. So I think when you look at EM ex-China, the beta is strong, the beta is there, it's keeping up with developed markets, which should in turn lead to an interest coming back.
But are you ultimately, as a specialist investor, looking for really good companies rather than focusing too much on domicile?
So with regards to how we think about the world, we're looking for good companies that are trading at reasonable valuations, where the operating momentum is surprising positively. There's about 1,600 companies in the emerging markets universe we can invest in. We think that's a nice wide opportunity set, and it's down to us to go and reel in the fish, build 70 to 90 stock portfolios.
The strength of the greenback has obviously been a huge problem for the asset class in recent years. So how do you see that playing out in terms of affecting inflows into emerging markets? Is that currency situation going to come back into the favour of EMs?
Yes, I think that's a $64,000 question, right? You look at the correlation between emerging market equity assets and the dollar. It's 1 for 1 on the negative side. So we've had a massive bull run in the dollar over the last 10 years. Clearly, a big headwind for the asset class. I suppose the question is now, where does the dollar go from here? I'm not a currency strategist, so don't take my word for it. But I think what's interesting is how different interest rate cycles within emerging markets are versus developed markets, i.e. the US. So where we are with emerging markets is they've pursued conventional monetary policy. They've raised rates fast and hard over the last couple of years, such that rates in places like Brazil, Mexico, Hungary, Chile, they're coming down. If you look at Brazil and Mexico as an example, real interest rates in those markets are still 6% and 7% respectively, which means rates will continue to have to come down. And I think that delta to the cost of equity when investing in those markets will be positive for those equity markets. Contrast that to the US in terms of where they are in their interest rate cycle. You could plausibly see a scenario where the dollar may not come down, but probably peaks out from here on in. But we'll see.
What about India in terms of the future of emerging markets? A lot of people, obviously, there's a lot of interest in India and a lot of research done on India, but is it as simple as backing India to follow or emulate China's growth trajectory just because they're similarly large countries?
Yeah, I think that's probably an oversimplification, James. India is the market that everyone loves to love, and China is the market everyone loves to hate. I think those are the two main consensus trades in emerging markets today. Having said that, I think a lot of that valuation premium that India commands is justified. When you think about what an investor pays up for, they either pay up for growth or they pay up for certainty. India gives you growth, where China is not delivering right now. India gives you certainty around policy, where China doesn't today. And that policy is around Prime Minister Modi and his agenda around really pushing the economic side of things. And so whilst he might not be successful in all his endeavors around the economic reform, the fact that the market knows what he's trying to achieve gives you some certainty, and the market will pay up for that. So it's a market that we've spent an inordinate amount of research effort on in the last 18 months. We've done 7 different research trips in that market. It's an area where we're exposed to in our portfolios, but we're deeply cognizant of that valuation spread between India and China, coming back to those two consensus trades I was talking about.
What's the biggest long-term structural opportunity of them all? Of all the markets you look at, what stands out to you from that point of view?
I think if you look at one of the big things that's changed in emerging markets or global markets over the last couple of years, it's supply chains. Supply chains have been recalibrated, rejigged. And that's a function of really geopolitics, changing the equation around how the US deals with China. And so that supply chain picture, I think, is a structural change that is underway. Take, for example, Mexico. Mexico has never done more business with the US than it's doing today. And if you look at Mexico's share of US imports, it's crossed China as their number one partner as of a few months ago. So I think that sort of structural change around supply chains is clearly leading to opportunities.
What about elections, Varun? They're going to involve more than half the world's population in 2024. We've already seen Taiwan, Indonesia and Argentina, and we're going to see India and Mexico and South Africa as well in 2024. And of course, the big kahuna, the United States election. So do you see those events as headwinds or tailwinds?
It's an interesting question. It's an election year, isn't it, James? I think arguably, of all the elections you've mentioned there, the most relevant one to emerging markets would be the November election in the US. We've got a Republican candidate who's jumping up and down, making a lot of noise around tariffs, and we've seen that movie before. Like it or not, we need to be cognizant of what that provides, both by way of risks and opportunities. So that's an area that we're giving some thought to today.
What about areas like the Gulf states that a lot of emerging markets used to be simplified into Eastern Europe, Africa and emerging Asia, but now there's newer geographies coming onto the radar of emerging markets investors. Do they bring something really unique to emerging markets, or are they similar to other parts of your asset class?
I think that's the beauty of this asset class. It's adapting, it's changing. There's new entrepreneurs, new opportunities, new markets. And I think you rightly point out that the Middle East is one of those newer opportunities, those newer markets. And if you look at what's happening in the Middle East, I think there's some real change coming through in places like Saudi Arabia, in Abu Dhabi, in Dubai. I think particularly Abu Dhabi, Dubai, they're benefiting from migration, expats coming through in swathes. The property markets in both those markets are booming, absolutely booming, and that's an area that we're leveraged into. I was in Abu Dhabi over the December break, And it's a fascinating town. It's one enormous construction site. All you see are cranes wherever you look. So it's work in progress. I think there are good things happening there. And to give you a sense of how significant change is in that part of the world, Ras Al Khaimah, which is one of the smaller emirates, has been given a license to have casinos in that emirate. This is groundbreaking. So you've got the US casino operators now that have been awarded licenses. So I think a leopard can change its spots, and clearly spots are changing in the Middle East.
What about at the upper and lower limits of your asset class? Are there any frontier markets you expect to graduate up into the emerging markets world? And at the other end, it seems like South Korea, for example, doesn't really want to be promoted to developed, and even Israel's there on that border, and there may be geopolitical worries there. But is there much change at that upper and lower limit of what's considered emerging markets?
Yeah, I think if you're a betting man, you'd probably say Vietnam is in pole position to be upgraded to EM status, and I think that comes back to our earlier conversation around supply chains. Vietnam are a massive beneficiary of supply chains moving in their direction. So I'd probably say Vietnam looks particularly interesting. My colleague is in Vietnam this week, meeting companies on a research trip to try and get ahead of what we're describing here. I think at the upper end, Korea is, it's a fascinating case study. You've talked about emerging markets being cheap. Korea is the poster child of cheapness. It trades at a 30% price to book discount to an already cheap emerging market equity asset class. I suppose what's happening in Korea today is quite fascinating. So the government have woken up to the fact that elections are happening in a couple of months, and what's interesting there is 14 million people in a population of 44 million people are participating in the retail market today. That is a record high retail participation. The government's finances are obviously tight. So how do they get people feeling good about themselves? Get the value of the stock market up. So the Koreans have looked across to their friends in Japan, and in Japan there's been an excellent corporate value up sort of program that has led to companies aligning around return on equity and aligning to get their book values up. Korea are looking at that and saying, can we do the same thing in our market? So I think Korea is the market that's always been flirting with DM status, and for whatever reason it hasn't made it. I think Korea could be the surprise package for this year. It's a market we're looking closely at.
Varun Laijawalla from 91. It's been a great pleasure going in depth with you.
Great pleasure. Thanks, James.